We're snorting cap rates and shooting up cash flow here at Deal Junkie. Welcome back to Deal Junkies. I'm Gabe Johansson, back in the SMI studio with Trevor Howard and Mike Nuss. Have you guys kissed and made up yet?
Never. Not when we're arguing about that shit.
Are you still fighting?
We just do it for the audience because they appreciate it.
Did you take it out in the parking lot?
I would
Throw
never.
some swings?
I would never fight Trevor. I appreciate him. I respect him too much.
You fight him every
Now,
single time. you see him.
Dane, on the other hand, I'd fight that fucker in a heartbeat.
Where is Dane?
Dane's at a wedding
He's hunting.
and then going hunting.
He goes to a lot of weddings.
He's got a lot of friends, apparently.
Wow. All right, so we want to bring you guys a little short market update.
Short.
Mike's going to tell us the state of the world, what's happening, jobs report.
Can you tell us
retails
why it matters? Because
report.
we talk about this, and I feel like nothing's changed with what we would
What are
do
you
with
talking
this
about?
information.
Geopolitics. It
Deals
does
get harder.
Are they harder than the last market update?
It changes
2 weeks,
it-
3 weeks ago?
It has changed a little bit, but the flow of money, I think, is what we're really looking for. We want money to flow again.
Oh, I'll talk about money. Cool.
That's
Yeah.
that's what
That's
you
what
think
this is all
talking-
about.
No, let's talk about jobs.
No, economics is the psychology behind the flow of money. That should be the new definition of economics. Is the psychology behind the flow of money.
I don't know if that's what that is.
No, I'm here to redefine words to a better, proper definition. That is my existence in life.
You're here to make up new
Make up
words.
new words.
Okay, so what happened? We had a jobs report, we had a retail report. I mean, to me, I'm looking at it and the news. It looks like it's kind of bad news, which we're waiting for, because then for us, that's good news that the Fed may actually lower rates, which may not actually do anything positive for us. But all the job, you said this. I listened to one of your episodes, Mike, where you were talking about like every fall they do these job revisions. And then suddenly it's like, oh, all year long we prop it up and say jobs are great, jobs are great, jobs are great. And then every fall, the last couple of falls, and this one included in August.
Dude, I got Chat GP to do some stuff on this today, and dude, it's been bad forever. It's been like we've been plugging. You look at it and you're like, oh yeah, this all makes
jobs,
sense.
the
We've been
jobs.
plugging. We've been keeping a recession from happening forever.
Actually,
for-
I think we've just been propping up
Oh,
fake numbers to
Yeah,
make it look like
well,
we
just
weren't in
over a
recession.
decade with quantitative easing, we've just kept things from falling apart.
Are they going to fall apart now?
It feels like it. It feels like my expectation is that the word stagflation will be heard significantly in the last 3 days of this month and the first week of September, and then it'll wash away.
Isn't
to
that how it
whatever.
works in every economy, though? Because there's print more? Isn't
So-
that the whole thing, or no?
So well, let's just get into numbers to give people background so they understand what the hell we're actually talking about. So in August, we have the BLS job revisions. Let me bring up the actual
Bureau
stats.
of Labor Statistics.
Correct. And so this is what we've seen over the past 3 years, and now we're about to have the fourth. So in 2023, and this is inflation and then also the jobs revisions. And then this unpacks to what you were about to say, which was last week we had jobs come out, and jobs numbers came out, more losses than expected, so a softer job market than expected. And then this week, inflation came in at expectations. So those two things combined, we would typically see money flow into bonds. They'd allocate to bonds. Bond yields would come down. Mortgage rates would come down. This would be good for real estate. But that didn't happen. Bonds hardly moved at all. So money did not react typically to what you would see from those two things. And the context behind that is what's the relativity of the trend, right? So even though jobs went down, and the trend is in 2023, the revision was negative 306,000. In 2024, it was negative 818,000. That became a very political talking point in the election. In 2025, it was negative 911,000. And then
What does that mean? Like there's negative.
revisions.
The
So
job print that came out, they came out later in the year and said, oops, we were wrong. It was actually 1 million less jobs.
the
Of
quarter
people being employed.
the quarterly
That should have
reports.
been.
Yeah. So looking backwards, the quarterly reports added up to 306,000 more jobs than what our actual data now shows. or 818,000 more jobs than our data actual shows. And so in August, and this has been a relief to the real estate market the past 3 years, is all of a sudden in August, we have this softening labor market, right? So we have these big revisions. They show a softening labor market.
Meaning there's more people that want to work than jobs
This
there
is
is.
not unemployment. This is job creation.
Okay.
So this is new jobs.
Correct. So a softening labor market means a slowing economy, which is good for interest rates or good for the let's change monetary policy and start lowering rates environment, right? Because it's a softer market. And then at the same time, if you look at inflation numbers over that time, so this is CPI, not PPI, but in 2023 is 3.2, in 24 is 2.9, and 25 is 2.7. So we had this trend working together where inflation was coming down and we were having a softer job market. And so that's why we saw the real estate market start to pick up until about a couple of years ago.
How did they get this data?
The BLS is the Bureau of Labor Statistics.
They go off payroll reports.
You start,
Okay.
yeah, payroll reports.
There's a public and private report that they do. So they do a study. I don't know how they get it through.
Non-farm payroll reports.
Yeah, non-farm reports. And then ADP puts out a
Correct.
private payroll report, and that's just based on how many people are getting a paycheck every single month.
Right.
Then
And-
they do the unemployment, and unemployment is how many people are looking for a job, and that number actually decreased from 4.2 to 4.1, but then they said, but our labor market participation has gone way down because we have tens of thousands of people that are just no longer looking for a job. So now you have a whole bunch of people that are in the age range to be working that are not working.
How accurate is this information and data?
Over a long period of time, it's relatively accurate.
I think they're all listening to you, Trevor, and saying they shouldn't have a W-2 and they should go start their own business and buy a building.
Yeah. And to answer your question, it's accurate enough to just see trends and make assumptions based off trends.
Okay.
Okay, because that's all we're looking for is a trend. We don't care about the details of the data as much as we care about what's the trend of the data and what's happening. So on August 28th of this year, the revisions for the past quarter up to Q1 of this year will come out. And do you think that's going to be negative? Do you think it's going to be positive
For the revisions?
for the revisions?
Oh, I think they already did it, didn't they? And they said they revised it way down?
No, they come out August 28th.
Oh,
The
it's
actual
later this
revisions.
month. Oh,
Yeah.
okay. I think they're going to revise downward. That would be my guess. That's what they've been doing every year.
That's what might be my expectation as well. So, outside of the inflation, if you set that one indicator aside, everything is lining up like this should just be a continuing trend of what's been good.
Good
For
us,
real estate.
not necessarily for the economy. So
Right.
we're to put this in perspective, just to cap this off, we're saying that we are over time trending that we are creating less jobs year over year in our economy,
Yeah.
which is for the economy a bad thing.
Correct.
In real estate, we're rooting for it because we want them to loosen monetary
Right.
policy and free the money flow up again.
Right.
The idea
And
is
the-
business owners borrow more money to hire more people.
Well, the belief is through fewer jobs, you have demand destruction, you have less purchasing power. Less purchasing power is downward deflationary and
yeah,
impact.
dollars need to.
So from a jobs creation standpoint, we're trending downward.
Yeah.
Then you start to look at unemployment, and what they're looking for is the unemployment number to tick up. However, we have people leaving the workforce.
is that due
which
to the
means-
age range and retirement age?
No, there are people within that age range that should be working that are leaving the labor force. So we have a lower rate of participation in the workforce than we've had in decades.
What are they doing then?
As a percentage? I don't know. I don't know what they're doing.
So you're sidetracking me. So let me finish.
They all did what you did. They
So-
house hacked and retired.
So the inflation numbers that I gave you, that was July CPI rating. So in 23, it went from 3.2 to 2.9 to 2.7. But what was July CPI rating?
We were back in the fours, weren't we?
3.4.
3-4.
So we went up 20%. Is that right? I don't know. I can't do quick math. I shouldn't do quick math.
And you're not looking at core. Core CPI was like 2.5.
Yeah, it's
You take out food and gas and you get a lower number.
there's fine print. I don't know. Yeah, correct. I don't know. But a CPI number, the same one. So the trend. So the problem is when the market started getting better, when inflation was good, we got inflation in target to where we wanted to be, which was in 23, 24. Inflation numbers started getting better. It was disinflationary. that started feeling better for the real estate market, especially in August when we had big jobs revisions, because then money would flow into the bond market, because then this would be a good thing because we had what we want. And at some point, I think it was in 2024, the comment of jobs over inflation became the discussion, which is we're good on inflation. We don't really care whether or not inflation continues to go down. And this is when the sticky comments came out, which is this last mile of inflation is going to be hard to get down. And so we don't care if it comes down or not. We're okay where it's at. We're really focusing on jobs. And so as long as jobs came down and we had a softer labor market, then that would lead to a rate cut.
Which we got.
Which is what we got because we had those big revisions and we got the rate cut.
But the bond market is still not pricing in a rate cut.
So the bond market has flip-flopped, and now it's no longer about jobs. It's no longer labor over inflation. It's inflation over labor. And because inflation has gone the opposite direction. And so now we've passed this threshold. And so this is why I'm not excited about the real estate market from a transaction volume standpoint, is because interest rates are going to be very sticky going forward. Because inflation is prevalent, and from a government spending standpoint, we're not slowing down. And then from an oil exacerbation standpoint, that isn't going to subside. And so there's no good factor. There's no way you can look at the concerns about inflation and write them off. And the reason I look at the bond market, which Trevor always ignores, is the bond market answers this question. Should we write off the inflation or not? Should we focus on labor over inflation, or we should focus on inflation over labor? And the bond market showed us when we should shift from inflation to labor. And now the bond market's showing us when we should shift from labor to inflation. And that's why the 30-year rate is, the long-term rates are the highest they've been in since 2001. So that is not good for transaction volume going ahead. And so what do we expect? It's going to be tough to sell. Doesn't mean you shouldn't sell. It's going to be tough to buy, but the buys that you get will be really good buys. And so you got to need to work a little bit harder. You can negotiate a little bit harder. You can understand you have more leverage now than you did last year as a buyer, and vice versa for a seller.
So what are we waiting for? I feel like the market is still broken, and we need it to be fixed. What do we need? Do we need the money to flow again for it to fix itself? Does that mean lower rates? Does that mean that we have to have a correction in pricing? What I'm interested to see is if residential pricing starts to correct the way that commercial pricing has over the last 4 years.
Yeah, and I think that's where the kind of the lockdown and the shelter component come into place. So to answer your question, what do we need to happen from the residential market, the 1 to 4 unit world? We just need money to flow. We need money to flow back into bonds. So the macro money needs to see risk other than inflation right now. And that's what it's seeing is inflation's our biggest risk. So we're not going to debt. We're not going to bonds. We're going to growth. We're going to equities. We're going to stocks. We're going to AI. We're going to technology, right?
What's interesting is we talk about risk on and risk off, and the stock market and the bond market are moving in opposite directions, in my opinion. So you see these bad job revisions, you see whatever you see with inflation, and the stock market actually likes it and keeps going up. The bond market, you would think, does that make sense what I'm saying? Like, you would think that people would, in the bond market, go like, oh, we see that there's going to be less chance of a rate hike, and so we're going to start baking that in. But the bond market is actually, they're thinking that the Fed's going to raise rates, and the stock market would almost bet that it's going to lower rates.
Yeah, and I think it's a little even more rudimentary than that, where they refer to the bond market as smart money as opposed to the stock market, which is then, I guess, speculative money, right? So I think bond market is just, regardless of what happens from a rate standpoint, inflation's real. It's here to stay. We need a premium to be in the bond market. That's all it's saying. Yeah. And so their yields are higher. But on the stock market side there's so much a byproduct of having a big stacks of capital and a lot of money, and a big belief in AI and a big belief in making these bets on top of, well, where else do you want to allocate right now? Do you want to allocate to real estate? Do you want to allocate to Bitcoin? We know we're not allocating to bonds. Should we allocate to gold? So that was the trade-off. What the activity we saw this past week that typically would have gone to bonds went to gold.
What would have happened if, and this is a hypothetical, what if we didn't have this AI boom simultaneously with a Middle East war? Or are the two connected?
Well, I think they're definitely connected.
Is it we're able to go to war because we have the boost of the AI boom?
How much of war is determined by technology? So how much money and spending, think about this, the most spending goes into war, and war is dependent upon technology. So a big portion of funding for new technology happens through war and weapons. And so how much of it is, well, Ukraine and now Iran is just, well, we got getting rid of all of our old weapons and bringing in all of our new technology, and this gives us the field to do all of that. And this isn't a political hint against the current administration. This is just how the government is designed. Whether or not Trump got elected, I think we'd be doing the exact same thing. We'd be passing, $500 billion war packages. It would just maybe be in Ukraine instead of Iran.
So the smart money would be to bet on the companies who are making technologically advanced weaponry.
Yeah, I think that's always a good bet.
Because is this the Halliburtons of the world or whatever? Like, I mean, because I've seen that the government is going to them and saying, like, we need to know how to, like, increase output significantly because we need more of whatever, drones, missiles, whatever it is they're making. So that's where the money's all going. Well, the money is flowing. It's just flowing into
technology and energy.
Tech and weapons.
And energy and data centers, compute, technology. It's all combined. Yeah.
So the world, I mean, really what's happening is the economic landscape is changing. The way money's flowing, the way oil is flowing, the way governments are reacting to one another, this AI race for whatever that's going to be to have come up with the next super weapon or whatever that's going to take over the world. That's crazy.
Yeah, it's all geopolitically driven, along with the huge change in technology at the same time.
So where does this all go? I mean, the last thing I saw Trump say was like, I think we'll just stay over there forever. And that's kind of what I thought when we went there. Is like, well, I think every Middle East war lasts forever. So, I mean, we were going to go to Afghanistan for a few months. We were there for, 17 years or something? So is this the next Afghanistan?
So that's the scary thing, is if you put into context how, in the grander scheme of things of the Fed rate, of the long history of the Fed rate, the low rate environment is that small blip in time from 2004 to 2022. So 18 years out of the whole entire chain of a Fed rate, the 10-year yield. So this is the 10-year yield. So out of the entire timeline of a 10-year year, only 18 years of that were we under 4.5%. Right? So, okay, well then what's normal? Because we have an entire generation of people that believe a under 4.5% 10-year yield is normal. Like, that's just how the economy is driven. We have an entire 2-decade data set that says this is what drives economics. The quantitative easing data set. So what happens going forward? Because if we're not going to reduce spending, if we're going to continue to be in long drawn out wars, if we're depleting our oil reserves and we can't produce oil and we can't deregulate it, and oil's too cheap to incentivize private companies to create oil, and we can't create electricity fast enough. Okay, so we have to spend but we're in an inflationary environment. Like, what happens to inflation? And if inflation stays high...
Because if you spend too fast, you're going to raise inflation.
Correct. And so what? Now interest rates go up even higher, but they were already at a point where higher for longer, and now higher for way longer is just already very restrictive to our economy.
Is this just a race for energy? I mean, is this all about energy?
Probably.
Isn't that weird?
Mm-hmm.
It's all about energy.
And Mike's
Oil,
is negative.
Natural gas, solar, water. It's going to be a race for water.
There's a lot of reasons to be really fucking pessimistic. But at the same time, there's plenty of reasons to be optimistic. It's just a matter of where do you want to focus your energy.
Well, Warren Buffett said be greedy when others are fearful. I think a lot of people are fearful right now. So how do we be greedy? How do we take advantage of this?
I don't think you need to worry about that.
Did he just call you greedy? I think he just said you're greedy. You're so greedy you don't even worry about being greedy. I think you do that. You be a shrewd negotiator, just like the Blazers are being shrewd negotiating with the city of Portland, and the city of Portland is trying to figure out a way to be screwed back. You know, it's you negotiate. Negotiations, when your capitulation window's smaller, meaning your area of overlapping agreement from a buyer and a seller, when that's smaller, you have to negotiate harder.
So going to the resi world, because I know you're the specialist in this, Mike. In the 1 to 4 unit space.
I think you call me small.
You're small.
Micro Mike.
Micro Mike. Tell me, is the market going to change? I hear people say all the time, like they're waiting for a housing crash. I don't see a housing
Sideways
crash.
and volatile.
You got the lockdown effect you talk about. A lot of people are in 2.5%-3% money, and so just there's no
I can
reason
see
for them to go anywhere. But
so I mean, it's all, you know, your values are based off large data sets, and so we see a volatile market. So essentially, your curve is flat. But going on a flat curve, you're seeing this big volatility of price change, right? So it's that up and down is a lot steeper than it typically would. And instead of seeing this step up over time, it's just flat.
But we're seeing on the market today, I read it, I don't know if this is a true statistic or not, but an MLS statistic that said like 50% of the houses on the market today have had a price reduction.
Mm-hmm.
I mean, so I don't know how big the price reduction is, but clearly
that's just relative to what? Relative to market value, relative to they priced it too high, relative to that was already priced aggressively, and then they reduced it.
If you priced it
again.
right and it sat on the, I mean, I guess if you priced it right, it would have sold. But if you thought you priced it right based on 6-month trailing and it didn't sell in 60, 90 days, you overpriced it because you're chasing the market down.
This is where being an appraiser makes me really just discount a lot of statistics.
You hate appraisers. Now you're calling yourself an appraiser.
I am. I was. I'm a trained appraiser.
Yourself, Mike?
Yeah. But like price reductions, because again, it comes back to the psychology of the owners and the psychology of the agents. So psychology of the retail market, I really discount price reductions because I think most of the time people aren't pricing something based on reality. They're pricing on what they hope to get. Mm-hmm. For the longest time, the market would just give it to them. And so now price reductions, are they really relative to, oh, you priced it correctly or you priced it to what you hoped you would get and you didn't get what you hoped you would?
And now we got to adjust. And that's what a lot of brokers are having those conversations. Like, hey, we can come out a little hot, but if we don't get this thing under contract in a month or two, we got to talk about bringing it down.
Yeah. So I look at that as a useless stat, just like I look at, well, a nominal, a 1 or 2% price change year over year, it just doesn't matter. It's so nominal in the grander scheme of things. More, and even though it doesn't point to anything specific, more valuable is a tool like the affordability equation, because it just gives you a general macro data set of, with this amount of down payment, with these price inventory levels, with this mortgage cost, generally this is what people can afford. And as that changes over time, you can see a direct correlation to the change of sales volume, and then the change of sales volume relative to the amount of inventory and options, then you see that in the prices. Yeah. And so what we're seeing now is just a lack of consistency in the correlation between these things other than affordability. And that will remain for the 1 to 4 unit world because of the shelter component. And I have a low interest rate. It's really cheap to live where I'm at. Where the commercial world is, well, maybe that floor ratchets it down a level. Because if our capitulation window is smaller and the only way to make a buyer happier is for a seller to come down, what percentage of the prices now have a stepped down seller versus a stepped up buyer from the relative from the previous year, if that makes sense?
Yeah, we were out looking at the Street of Dreams, and I was looking at these houses and how much they cost, and I was looking at what it would take for me to build my house. And my house, I started doing the math of how much per month does it cost me per square foot in my house. And it was crazy to compare, slightly bigger or better house than what I have is like 4x what I pay today in my house. Like I pay like $1 a foot for my house. Mm-hmm. And you're going to pay, and you just sustained it because you're defining your cost basis to your cost of money.
You're tying your cost basis to your cost of money.
Exactly.
Yeah. And we just live in a completely different world. So everyone in your shoes is like, that's a cool house, but not to the 4x of my payment. Yeah. Cool. Yeah.
Exactly.
Yeah. So that means we're just going to have smaller transaction volume. But in commercial, we have to have it. Yeah. And even with the extent, like, dude, it wasn't a joke. When was it? Like 2 years ago, we were saying stay alive to 25 and persist to 26. And I said, because we're going to have a depression in set 27. Like that's yeah.
You feel like we're still heading that direction?
And with depression, meaning those specific sellers that have been kicking this curve down this can down the curve, thinking it would change. They're just getting further and further down into because values are down 30%. There's no question about it.
In commercial,
like residential, commercial, 5+ unit values are easily down 30%. Right. So that's why we feel like we're buying at the bottom. That's why we're getting good basis relative to end term value. It's why we're getting good basis relative to cash flow. We're getting good cap rates relative to mortgage debt cost because that's what the bottom of the environment looks like.
It's not a great time to buy a house necessarily yet, unless the price is correct a little more, but great time to buy multifamily.
Well, and the other thing is it's going to be more difficult to extract equity. I think this is an important point. So like if you look at our operations from the 46 unit, just in the first 6 months of ownership, if we can prorate that out into a T12, we created $2 million worth of value. There's no way now we can extract that $2 million of value.
Maybe in a refi.
Correct. Maybe a little in a refi, but not, we could. You're right. You can get an appraisal and so 80 or 70%, but the reality is what's on paper. You used to be able to print what was on paper. Right now, what's on paper is like, I don't know. Last month, maybe next month, possibly. Right now, I don't feel it. That's weird.
Are you trying to build a house right now?
No, Mark really wants to build a house for me.
That's because Mark wants to make money.
That's his dream
on you.
He wants to build you a house specifically?
Yeah, I took him to go walk these houses too, and it was funny to watch him look around it.
But doesn't Jan want to build a new house or something right now?
They can all want what they want. I just told them, you got to find me a better view, and you got to do a good deal.
Could you
when I see what it would cost to build my house again?
There's lots of units of comparison you can go down to say no on anything they want to put in front of you.
Yeah.
Can I wrap your debt and move into your house?
I would pay more. I don't necessarily need a new house, but if I got a new house, I could pay more. I could afford to pay more. I just don't want to afford to pay more.
Yeah, cheap.
For what I'm going to get, for what I spend, I don't see the value.
And if rates
that's how most homeowners feel.
Go ahead.
Could you do it on a lake so then we can put our boat there and then I can come hang out there?
Yeah. Why don't you do it on a lake?
Because you're older and wealthier and wiser.
And
I'm cheaper.
Because he made a mistake and he learned from his mistake and now he's feeling less liquid.
Is that the good news? He has good news. He's broke and he lost a lot of money. I have good news. I learned more lessons.
It's all about framing, man. It's the Gapper game type mindset. But going back to your like if interest rates came down to 5.25 or 5.5, that would change your equation. You're like, well, at 3x now, I really like that new kitchen. And having that custom little.
Well, just in 7 years, it would cost almost twice as much to build my house for what I bought it for.
Why do you want to build a house? Can't you just buy one?
Because that's what you do when you get old.
Yeah, you want it to be yours. And
There's a couple sick ones we could get you like a $5,000 payment on right on the water.
You should buy it.
I don't want to pay $5,000 a month. But I want you to, and then I want to utilize it because I'm going to take your payment from you.
Right on the water, where?
In Portland area, like Orange, Westland, like.
Maybe Westland or Lake Oak.
Yeah, we were out there.
On that gross river, dude.
Oh, dude, it's so
he
cool.
He goes there all the time.
It's so cool. Did you hear what he just said?
Yeah.
Except for the months of half of August or half of July, all of August, and half of September.
I don't know. Some dude took us foil boarding out there, and he was pointing out the houses he wanted, and then he was like, he owns a business, makes good money. But he's like, I don't really want to pay whatever $9,000 a month or $8,000 a month for this thing. And I was like, Dane, we should set this deal up and get his payment down to $5,000 for him, and just call him one day and be like, hey, it's done for you. That'd be so sick. So we should do that for you so I can use your backyard.
Okay. How much can $5,000 a month afford right now?
Well, if you do it creatively.
Okay, creatively,
a lot
how much
more.
can it afford?
$1.5 million.
Okay, that is not getting you a house on the fucking Willamette River, dude.
$1.5 million?
No.
Oh, you should look at the market, Mike. I thought you're the resi guy.
Not the houses you guys were pointing out.
Like 3,000 square foot homes.
You think those are 1.5 million on the river?
Well, I think one of them's 1.2 million right now.
Oh. You can't live in it, and there's a fucking rats.
It's moving ready.
I have noticed. I did ask ChatGPT to set up a thing and tell me whenever a house over $1 million goes on the market in my area, and Chat says, well, there's like 2 trades a year that happen. There's like 2.
We'll let you
sales
know.
that
Though.
happen.
Yeah.
Yeah.
But I've noticed it sends me this little thing. It says like, hey, did you see these guys? They lowered their price from 1.5 to 1.2. Like they're doing like in the over $1 million bracket. They're dropping price $200,000-$300,000.
Yeah.
So the correction is happening on the high end. It's that if you're in the 350 to 450 range where everybody's trading, like the correction hasn't happened as much there.
You should just go assume someone's debt.
Well, that's a possibility. I'm not that motivated.
But your wife is.
I'm gonna
And you have to make
I'm
her
gonna help-
happy.
I'm gonna help her not have as much motivation. I'm pretty comfortable where I'm at, but I could see just doing the mental exercise. I could see where the average person is. I've talked to another guy that works with us here, and he's like, yeah, he bought like a starter home and paid it off, and he's like, oh, I could afford more now, but he's like, if I sell that and I go buy the next thing, he's like, what I have to pay for it doesn't. It's like, you move up from a $400,000 house to a $600,000 or $800,000 house, and it's like, am I going to pay that? It's like not that much more. I get another 500 square feet and maybe a little nicer neighborhood or something to pay this huge amount more. Like what you're getting for what you're paying, there's a huge disconnect.
Yep.
All right. Was that our market update?
Yeah.
Okay. I will just predict that I think that residential prices are going to come down. I think we're going to see.
Well, the last print showed them down like 1%.
Yeah, I
over
think
1%.
I think you're going to see more like a 20+% correction.
Dang.
What?
Hot take.
That's my hot
20% correction in prices.
Mm-hmm.
You think like over what period of time?
Over the next 2 years, 3 years.
You think residential prices will come down 20% over the next 2 years? How?
Well, I just think that rates are not going to come down, and that eventually people are going to have to sell, and the people that are motivated to sell because they have to move or want to move or don't want to be an unintentional landlord are going to lower their
But
price.
if you just put that into the affordability equation, do you know what happens to affordability?
well, it becomes more affordable.
It probably goes from like 90% to like 240%.
You think that much?
Yes. Yes.
He's going to chat GPT it.
That's okay. We got to go.
No, this is great. This is exactly how you use ChatGPT.
All right.
Are you gonna talk into it?
Okay, find the latest affordability equation for the Portland metro market. Then give me that same equation, but bring the median sales price down by 20%. What's the affordability rate for the most recent report, and what would the affordability report for that 20% price reduction be?
Let's see what it
It's
says.
going from like 89% to over 200%.
So tell us what those numbers mean. 90%.
100 means your neutral affordability. So above that is good, below that's bad.
And we're at 90 now?
Yeah. We went down to like 82 in May of 2022. So that's when we got our least affordability, was at the very bottom was like at 82. And then we get into the upper 80s. So it just says 98. That's not right.
Oh,
It says it was
wrong.
98, but it goes to 122.5%.
Mike, I think this is where you say you were wrong.
No, because I just looked at the
uh-huh,
graph and it was 89%. It wasn't 98%.
All right. Well, thanks for listening, guys.
You got my hot take.
What is the interest rate it used? It used a 6.1% mortgage rate. That's the problem.
Okay. Oh, well, we got to go.
Is it a problem though? That's my prediction. We're gonna bottom out at a.
But regardless, even with this scenario, it went up 30%, 25%. Like affordability went up 25%. So there's a threshold of affordability that will just keep prices from going down.
I mean,
further.
what was our highest affordability percentage?
Like in the 120s. So typically in 0406, we got just dipped below 100 for a short period of time. In the run-up years, we were in the 1-teens to 120s. In COVID years, because rates got so cheap, we got back into the 120s. But
So what's to say we're not going to one day end up back in the 120s?
120s, yeah, good point.
Maybe
That's-
not. Maybe not in the next 2 years.
According to this, a
that's-
20% reduction puts us into the 120s.
120s.
Yeah. I don't know. I think there would be a level of distress required, and we just won't see that level of distress.
Even
By
if
the
we go
way,
into your depression in 27.
just as well, just because of how qualified mortgages work and fixed rate versus non-fixed rate.
You think people will be like not so hot to go buy houses after this? Like before, it was like everybody's got to buy a house, and now it's going to be like
No, because I think just like you guys know that anyone who actually wants to use math to justify the purchase, that math won't change over time, right? So it just the components you put inside it are just different numbers.
All right.
If anything, it would entice people back into the market. It's like, look, it came down. Look, affordability's up. Look, you can pay it off faster.
It becomes a more balanced market.
Yeah.
Maybe at 110. Not
I think you're
120.
fucking crazy to make that statement. I think you're on drugs. Do we need to put you, like, are we concerned? You been drinking over there?
I'm just saying.
Smoking that yayo. Do you smoke yayo?
What is yayo?
I think that's cocaine.
Trevor's too young for Scarface. You haven't watched Scarface yet?
90s hip hop, baby.
Never seen it.
Yeah.
All right, guys. Wow. That one wore me out.
Me too. Let's never talk about this
Not
again.
as much as the previous one with Trevor's lack of understanding in psychology.
All right, Deal Junkies. Hey, if you want to book a call with us or find some tools to buy some real estate, go to dealjunkiespodcast.com. And please share us with someone you love, and we'll see you next time.